running through 6 a.m., this is all New York time, and after about 8 p.m. Why? Well, most of our clients, most retail traders are range traders, and those profitable moments line up with low market volatility. So what do? Pretty simple. You match a round peg to a round hole. You don't try to jam a square peg into a round hole. This doesn't work. RSI strategy again. I like it. Super simple, and it mirrors what our clients do very well. 15-minute chart on euro dollar, approximately 8 years again. Terrible. Let's limit ourselves to the hours between 2 p.m. and 6 a.m. Eastern time, which roughly matches up with when clients are actually making money. The difference is startling, and it really is that simple sometimes. Finally, market conditions. Super volatile. Clients are, on average, losing money. And I'll find you a promise. If volatility is at its top quartile in the past 90 days, our clients, this is real client data, on average are losing about 3 pips. Third quartile, half a pip. And when you drop to the bottom two, actually on average they're doing well. Again, how do we use this information? Well, you can read these numbers on dailyfx.com, but more importantly, you can use it to say, all right, well, again, I want to match the round peg to the round hole. Let's trade breakouts, the opposite of RSI. And let's say I'm only going to trade it when volatility is in its top quartile. Past performance, not indicative of future results, but I like it when intuition matches up with reality. Sure enough, the strategy works quite well in these conditions. Leverage, lower leverage, higher percentage probability. If you were trading on 26 to 1 leverage, on average, only 20% of all those traders were profitable. At 10 to 1 or 5 to 1, it jumps to 37%. And it's not linear, but it's close to it. Lower leverage tends to produce better success. Bring it all together. Money management, matching the trade strategy to market conditions, be it intraday or overall, and just using realistic leverage. Find this entire guide on fxdm.com, and thank you for letting me go over my time allotment.
Not at all, well done. It's, first point, you're so well trained by your legal team, aren't you? I thought you were going to start telling us that piracy of movies is intellectual property theft as well. Very well done. Okay, secondly, stocks. Tell me about stocks, because I think a lot of people have been told when they trade that actually, if the trade goes wrong, it's a great idea, dollar cost average, buy more, rather than cutting your losses on the trade. Discipline. Tell me about discipline as opposed to if you've got a really good idea but it hasn't worked, you still cut the trade?
If you're trading like most people, most of our clients trade ranges. If you know how range strategies work, you buy cheap, sell expensive. I think it's human nature. It makes sense, and most people do it. If you're doing this, dollar cost averaging doesn't tend to work, because if you're wrong, it probably means you broke out of the range. Cut the loss. Wait till the next one, because on average, things don't really go anywhere. When nothing's going anywhere, you're probably going to make money using the strategy.
Just explain to me 2 more points. One, low volatility, you're going to make more money or not?
Again, matching the strategy, most clients, this is real data, most clients are making money when volatility is very low. Why are they making money? Because they're all range trading. So if you're a range trader, match it to the market conditions. If you obviously if you've exited ranges, then switch to breakouts or turn trades.
And the last one for me, why does lower leverage equal greater success?
I'll use a very simple example. Let's say you start off with your account and you're like, I'm in the US, so we're at max 50 to 1. Not that that's really a limiting factor for me. You lose half your equity in the first trade. You have to make 100% to get back to square one. So, with that kind of stark reality, you realize that you can't afford to lose that big, and you have to be realistic in your expectations. Again, discipline and hand in hand with proper leverage.
Okay, before we move on, John, anyone on the panel or anyone in the audience got a question for David on